What is up, YouTube? This is the Working Investor. In this video, we're going to revisit ULTY in January 2025. The good, the bad, the ugly, my sentiment, my personal journey, my personal opinion, not financial advice, not accounting advice, not tax advice, not legal advice, not any type of advice, just my personal journey and observation. The pros, the cons, and the ugly. And so let's go into it. So obviously, I know a lot of you guys, I'm sure a lot of you guys, and myself included, are attracted to this fund because of the 100.21% yield, give or take, sometimes 95, sometimes 105, but that's what they target, about 100% yield. The question is, are you actually going to get 100% yield? Is that really sustainable? Or are you going to get something close to 100% yield? Or are you going to get something far lower than that, both in dividend yield and in total return? Like, is this kind of like, I don't want to say a scam, but bait and switch, Or is this like a reverse mortgage where you get paid, but you lose your asset? You know what I mean? So that's the question, right? So the pros of ULTY, of course, we spoke about the 100% yield, right? Right. And also another pro is that there is also the hedge potential. They kind of have a lot of hedge potential. Number one, they're very extremely diversified, and we'll look at the holdings in a second. They have like certain strategies to protect you from downside. For example, they employ a lot of the collar method, and that's a lot of I heard Jay from Max talk about why the fund stopped doing so poorly. Because they started putting in more stop losses with their collar method. And just take a little peek at their holdings. You could see, I just pulled this up this morning. You could see what they're holding right now. They hold a lot of different stuff. There's literally 99 different holdings right now, one of them including cash. I'm not going to bore you to death and read every single one, but just to kind of give you an idea of what they're holding a lot of these volatile stocks like Marathon, Tesla, MicroStrategy, and they also hold triple leverage products like the TQQQs, which is, triple leverage NASDAQ, and they also have TNA, which is a triple leverage Russell 2000, SOXL, triple leverage, the chips, and basically a lot of other stuff. And you'll see multiple different trades because they do all kinds of stuff. They can own the underlying, they can do synthetic, they can do call credit spreads, cover call, synthetic cover call, collar method to hedge everything. So they have a lot of different things they can employ. And you think with all this, gymnastics that they do with 100 different trades, and I've seen one day like over 100 different trades, different holdings with many different trades, that's very appealing for an investor, especially a option-based income investor like myself. I'm very into I like these methods. They're really, really cool. The question is, does it actually play out and does it perform in real life? That's the big question. Like, if you look at their total return since inception on Seeking Alpha, you see they have that's the big thing. You look at the price drop. They started off at $20 a share and they went down to like less than $10. They're in the $9 range, and they probably going to go in the $8 range after the ex-dividend date, on the ex-dividend date this week when they have the payout. So they're down over 50% in price, right? And total return, they're basically total return since inception 3.23%. Yet, of course, one would argue that you could see in September they started doing a lot better with, they didn't fall as much since September, and especially since October 16th, 15, 16, when they had the new prospectus change take effect, where they can do not only almost every single underlying, but they could do multiple. They have a lot of tools in the tool belt where they could play all kinds of different options, like we mentioned earlier, and plus, I'm sure more. And you can take a look at the prospectus. And don't get me wrong, I desperately want to love this fund. I'm really looking to love this. I really want to like this fund because because of the uniqueness of it and the option strategies that it does. That has a really cool income. But, look at the chart. Of course, like this is what I'm talking about, right? So, of course, it's been falling off a cliff since inception. And I think they did have some freedom to trade almost anything, but, any underlying, but maybe not the strategy leniency. And you could notice that the rate of deceleration improved, as you got into like September, and then quite certainly in October, it kind of, they're pressing the brakes. They're about to hit a wall, but they're kind of pressing the brakes before they hit the wall. And I entered my journey on the 3rd of September when I started trading it. I already started noticing it back then that it's starting to slow down. But and bear in mind, look at this chart. When you look at this chart, it feels like we're in a recession or something, right? But this is a environment. This is a, for the majority of 2024, we were in a bull market. The Nasdaq is up, about 30. I don't know the exact number. I think about 30%. S&P around 25, 26%. Somewhere in this range, and this fund is down 55%. I mean, one could argue that, of course, 100% dividend yield payout, of course, the price cannot sustain that. The price cannot be stable with that price, right? You can't have your cake and eat it too, right? But the question is, when you go for 100% yield, and then, and then 100% yield for a $20 fund eventually goes down to a less than $10 fund. 100% yield means you get about $20 in payments throughout the year, and they make 13 payments in a year because they pay every 4 weeks. But 100% yield of a $9 fund is a lot less. It's less than half. You're going to get about $9 in dividends throughout the year, divided by 13 payments throughout the year. So if your cost basis is $20 and now it's down to $9, your effective yield is like half. And if it keeps going down to $4.5 a share or $2 a share, where would your yield go? All right, your yield will just be dwindling down and down and down. And of course, somebody could constantly reinvest, try to lower the cost basis as much as they can, but it's almost like diminishing returns because you're just chasing after something that's just dropping in price. And the worst thing is it's also dropping in, the yield is staying around the same, the target yield, except for last month. I think it was about a 95% yield because, Jay mentioned it, because they we had a lower implied volatility environment, which, of course, understandable. But, pretty much, you're getting, pretty much diminishing price and diminishing your yield on cost is getting worse. So, of course, what I'm very I'm cautiously optimistic, and I kind of want to stand on the sidelines for now, because I do see it starting to flatten ever so subtly. I did notice, you have to think of both sides of the market. When the market goes up, market goes down. So, of course, what really, not too pleasant with this fund is when the market is popping, the price doesn't really move up too much. It's very anticlimactic. And then when the price, the good part is on the down market, relative to what it holds, these triple leverage, funds that they trade and all these extremely volatile underlyings, if you look at the fund as a whole and you look at the underlyings, it doesn't drop as much because they do put on the collar method. They do cap the downside. So it is cool that it doesn't have that very scary downside collapse, and so that's kind of cool. It has a little bit of a hedge edge that they could always deploy. They don't have to, but they always have the right to exercise that, which is cool. And I am still optimistic, possibly, but right now I want to put my funds on the side and wait and see. Now, one could argue that, timing the market is better than timing the market, and you're having opportunity costs by putting the funds on the side. But because this fund has shown to ever dwindle down in price, whether the market's up or the market's down, it just keeps having one direction down, maybe a slower speed on the way down. That means that chances are, and there's no guarantee, but if this trend continues, let's say it slows down, let's say it goes down, but in a slower rate, I could still put my capital back in. If I were to gamble, I would say I could probably put my capital back in, let's say in a few months, if it proves itself a little better, and I'll probably get a better price than I do now. Maybe I'll get it at $8 or something, right? If it's showing that the rate of decline is improving, right? I want to talk about 3 types of market environments when it comes to income funds. So there are funds that are the best. They give a pretty good dividend, and the price of the fund goes up. Income dividend growth investor, or should I say in this environment, high yield dividend growth investor. We saw that with MicroStrategy where, the initial start was $20 and now it's like $30, and it pays fat dividends, like 130% annualized yield. And a lot of people pretty much got their entire money back if you started off in the beginning, or even a little after the beginning, right? And I'm not saying it's going to be like that in the future, but just these are kind of funds that are really cool, right? That are high yield dividend growth investing. That the yield you get today, you under promise, over deliver. Let's say you try to promise a 100% yield or 80%, 50% yield, and the fund goes up in price. Let's say it goes up by 50%, but you're still targeting the 50% yield. But because your cost basis is much lower, your effective yield could be a lot higher than 50%. Is it a grower or is it a shower, right? So it's good to have funds that you could put your money into it and it continuously goes up in price, and your yield based on your cost basis is increasing in price. So the money you put in is commanding a better return, as it just keeps getting better as time goes on. So companies that have like positive drift direction is what I'm looking for, not a negative drift direction. There's another type of you know scenario where funds are range bound. Now range bounds are pretty cool too, because in range bound funds, let's say, for example, look at the chart of SPY T with range bound, right? So it started off, almost, closer to a year ago, like 10 months ago, or 10 months ago. It started off around close to $20. It's been the majority of a year, and it's still in the, close to 20. It's in the, it started, pretty much. I mean, it went down a little bit, but overall it targets 20% yield. And funds that are range bound, I don't mind. Like if ULTY would be range bound, if it shows that it could kind of stay within a range, right? And that would be incredible, because if it's staying within a range, let's say it stays between $9 and $11, or heck, even $8 to $10, right? If it stays within a range and you see that it ebbs and flows, but it stays within a range, it doesn't just have this overarching way down, it ebbs and flows, but kind of overall picture is down and, and to the right, then it's okay, because, somebody could try to get in on the dip and get some shares at a little cheaper, and then you kind of could see the pattern. There's no guarantee, but you can kind of see the pattern. It tends to be range bound, where it goes up eventually in price, and then you could find yourself potentially, having higher than 100% yield, right? So those are okay too. So there's the dividend growth, which goes up and to the right. So positive drift, the best case scenario. I feel like the second best case scenario would be like, funds that are pretty much range bound, and a higher yield fund such as ULTY, which commands 100% yield. I could stomach a range bound underlying, because a range bound underlying means you truly are getting close, at least close, somewhere in the ballpark of 100%. And you're kind of like, you're thinking you get 100, maybe you'll end up with 80. Okay, I could take that, right? But if I see that it's, going down to 80, and there's no signs of it, continuously showing some, support, and it keeps going down overall month over month, it doesn't really recover its dividends. You'll find yourself, unless you keep aggressively buying it down to keep your cost basis down, you find yourself, next, 60% yield, 50% yield, 40% yield, and dropping, et cetera, et cetera, et cetera. Reverse split, fall all the way down. So that's, again, like I hope, if the decline is ever so subtle, like let's say it drops, I don't know, 5-10% in a year overall, I could stomach that, because there's a lot of time to play catch up, right? Think about it this way. If it's targeting 100% yield, right? So you take 100, let's divide it by 13, because they pay 13 payments in a year. So divided by 13. So let's say, in a given month, if it drops, less than, a small portion of 7% down, let's say it drops 2% down, you have 5% extra to make up for that, in a given 4-week cycle, right? So, you can handle, but if it's dropping like 5%, 6% in a 4-week cycle, right? The ex-dividend date, a 4-week cycle, and you're getting 7.69, that's horrible, because let me tell you guys something. In a taxable account, breaking even is actually losing money, because breaking even means you still have to pay taxes on it. So you're losing money in a taxable account. Maybe in a tax deferred or or a Roth or IRA or any type of tax, deferred account or tax-free account, then, you could say that breaking even, it's a wash, right? But breaking even taxable account, you're losing money depending on your tax rate, but you're losing money. Let's put it that way. Like you can see, it has this negative drift. It's been going down the past 3 months, 10.77%, well, the year just started. So 54% in about since inception. So past 3 months. So let's say, so it just keeps, but you have to acknowledge it is starting to get a little bit better because the rate of falling is not as bad. But it kind of, this type of style kind of like keeps me up at night. This type of like, your fund is kind of dropping. The question is, how much is the damage? Some people don't mind. For me right now, I just kind of want to put my money on the side. I know that if it keeps having a negative drift, I could probably go back in on a, enter on a better price in the future, most likely, unless it really changes around, then it would be amazing. Yeah, so basically it needs constant reinvesting. Now, if you look at total returns since September, so since I started trading ULTY September 3rd, it's been up total return, 18.28%, which is okay, 18.28%. I have a lower total return because I keep getting out of it because I buy it and sell it because honest to God, I love it, but I have a love-hate relationship with it, and it's hard to make a decision with this type of fund because I definitely see the pros, but I also see the cons, and I see that, so the total dividends that I received since September 3rd is a little over $6,000. My total cost that I paid for all my shares was a little over $40,000. I sold it in the morning. Just for now, I'm kind of gonna wait. When I did the math, my equity was about 36,800. My total P&L, because you have it basically on price is negative 39, a little over 3,900. If you add the dividends that I received, so I'm totally net, I'm up about 5.09% in 125 days. That's because I got in and out, didn't let the magic do its thing. So for me, it's a 14.8% annualized return. But then you got to take off taxes. So if you think about, everybody has different tax rates. I don't think I'm paying 33%, but let's say hypothetically someone takes off about a third put into consideration for taxes. So a third of $6,000 is about $2,000, and that's pretty much not really making any money at all. If I broke even exactly, it would actually lose money. So, if I keep up this type of rate, my 100%, 100% yield. So normally, if you think of 100% yield, you should ROI in 1 year. But with 14.9%, the ROI would be 6.71 years. And as long as if it doesn't keep falling down further, right? And after taxes taken off, the ROI would be 7+ years. So anyways, yeah, what do you guys think? Are you guys like 100% in this, not 100% in this? Do you guys have any conflicting thoughts, feelings about it? Are you guys optimistic in the future? Let me know what you guys think. This is a journey. Anyways, this is the Working Investor over and out. I hope you guys have a wonderful trading day.